for tuning into this earnings conversation with JSW Steel. The company posted figuratively the first net loss since quarter 2 2014. But if you look at the operational numbers, they've come in much better than anticipated. The question is, in such a volatile time with geopolitical tensions quite rife as well, is it possible to give a near accurate prediction or a thought process about what could happen going ahead? And what are the thoughts of the management on the quarter gone by as well? Mr. Seshagiri Rao, as always, joins us right now with his thoughts. Mr. Rao, good having you. Thanks so much for joining in. Put this quarter into perspective for us, because I could ask you about what happened to the operational metrics, what happened to the bottom line, but I'm sure the quarter was much beyond what just came in the numbers. We talk about the numbers too, but just a broad brush of how operationally difficult it was and where you are right now compared to what you were when the quarter started off.
Yeah, even though we call it as a quarter, actually the operations were only for 2 months because April was a wash. So you have to look at these numbers as the 2 months numbers instead of 3 months numbers. That is one. Number two, the domestic demand, if you see in the month of April, has fallen by 91%. Even though it recovered, if you see the June number, the recovery only to the extent of around 50-55%. So the domestic demand is gradually, slowly recovering, even though the growth path was much better compared to April. So the way we have managed the situation is to export more quantities. That's why 57% of our total sales were exports. Over and above that, we have sold more of semis last quarter. 13% of our sales were semi-finished products like slabs, billets, and blooms. Generally, it will be in the range of 2 to 4%. So there are three main reasons. We have lost almost close to a volume, 1 million ton volume, and more of semis we have produced where margins are less. Third is the geographical mix where we have exported more. There are three main reasons due to which there was pressure on margins. In spite of that, when the sequentially the realizations have fallen by 12%, costs have fallen only by 4%, still we could make more than 5,000 rupees EBITDA per ton. We covered our interest fully. Our depreciation also, a part of it we could cover in the last quarter. If April was a working month, then we could have covered even more. So that was the reason why the performance appears to be not very encouraging in the last quarter.
Okay, so then can I ask you if things are showing some signs of turnaround? I have some previous quarter questions as well. Just before that, since you mentioned that if it was 3 months, then things could have been different. And because costs didn't fall in line with the realizations, is there some bit of a return of parity of sorts to the cost of the realization metrics, if you will? And now that you might be seeing full months of operations, are things looking slightly different for the current quarter?
Current quarter is definitely better when compared to the last quarter. The 3 months are available at the first one. The second point was in the month of June, there was some impact because of COVID-19 at our Vijayanagar plant. That's why production was lower in the month of June. So that is got corrected in the month of July. So in this month, we are working at full capacity. We will be able to produce all our units. So volumes will be higher. That is point one. Point two is because of global coking coal prices have come down by almost close to $40 per ton. So at least partial benefit of that lower coking coal prices will also flow into cost of production. Iron ore prices have gone up by 200 rupees per ton in the month of July. Even after neutralizing the impact of higher iron ore prices, because coking coal prices dropped significantly, the cost of production wise, I think we'll be able to do better than the last quarter. This is the second. The third is again the way I explained about volume. The geographical mix and the product mix. These are the two areas where it impacted our performance in the Q1 that get corrected in the Q2. So with that, we feel that Q2 will be better than the Q2.
Okay, so I believe 57% of the consolidated volumes were exported in quarter one. Now, I'm guessing a lot of this was not by design, but also because the opportunity was not there in the domestic market. How does this change, if at all? Ballpark, rough idea or some direction about what happens to the change in volumes? Will it be northwards of 50%, southwards of 50%? Any thoughts and the impact thereof?
No, if I see April month, our exports were over 70%. But if you see in the month of June, it came down around 50%. So because when the demand picked up in India, which was 9-10% in the month of April, it picked up to 50%. We started adjusting our proportion of exports to service domestic sales. That is what we have done during the quarter. Same exercise will continue. I don't think in this quarter the exports will be to the extent of 57% in the quarter. So it will get moderated. We are seeing definitely a recovery in the domestic demand. So in line with the recovery in the domestic demand, we continue to moderate our exports. So to that extent, there will be an additional benefit on account of the geographical mix.
And sir, where do you expect this demand revival? I mean, is it construction, automotive? I mean, what do you think will come up fast? Because even in automotive, we are seeing some very, very mixed trends based on what players have told us. I mean, RC Bhargava was telling us, for example, just using that as an example, that July would be fabulous, but post-August, because of the virus cases spreading, we don't quite know whether this stop-start will really impact volumes in a big way or not. What are your thoughts?
Whatever we have seen, the impact of COVID-19 across India, it is not uniform. Some areas are affected very, very badly, and some areas are not affected at all. So that's why in rural areas, the demand, every company is talking about stronger demand. The urban areas were badly affected. Similarly, geographically, if you see, South is affected more relative to North and East. Therefore, wherever it is not affected, their demand recovery is quite okay. And also what we observed in the last quarter, the retail side demand picked up. What it is indicating is that where there is no migrant labor problem like in urban areas, in tier 2 cities, tier 2 towns or other places where smaller projects, where local workers can come in and start the work, those work has already started. That is why retail side, one is credit flow improved over Q1. Number 2 is the smaller projects in the tier 2 and the rural areas, they are doing well. And also packaging side, appliances side, there is a good demand. The LPG cylinders, drums and barrels, tin plate product, galvalume, solar. These are some of the sectors where we are seeing definitely a recovery over Q2. The construction metro side, it may take some time. The construction workers have to come back. But gradually, slowly, we are seeing a recovery, maybe unevenly. It is not even across India. Even automotive side, tractors and two-wheelers, there is a good pickup in the demand. Passenger vehicles, also, if I talk to the two major producers in India, their schedules have improved over last quarter. But that is not the same case in commercial vehicle segment. But passenger vehicles, definitely there is some green shoots.
One is the demand side, Mr. Rao. One is how do you meet supply of if indeed the demand really picks up now, because of virus now spreading across. I mean, yesterday or day before, I was speaking to Biocon, and they were saying that now Tamil Nadu and some of the other areas are now seeing these spikes coming in. What about your production facilities and how secure they are? And would you reckon, I mean, to the best of efforts, but at times you can't really call it, right? So what's happening with your production? What kind of disruptions? What kind of scheduling?
No, as far as our production facilities are concerned, we are trying our best to keep them safe and clean and healthy. And we are ensuring that, particularly at Vijayanagar plant, which is our mother plant, we ensured that nobody comes in and nobody goes out. All the employees were able to accommodate within the plant. That's why we are able to restore the production in the month of July. But in other plants, we don't have colonies. So we have to rely upon people coming into the factories. There we are very, very cautious in ensuring if somebody is sick or somebody is not well, we are not allowing them to come in. There are a lot of tests which we do when the workers enter into the factory. So we are taking all the steps that are necessary, but it is not possible to say 100% it is safe. So anyhow, the impact of COVID-19 gradually the next few weeks or few quarters, a few months, it will go away, and in the meantime, vaccine will come in. Therefore, the worst is over, in my view. Things will look better going forward.
Okay, just a quick update, Mr. Rao, then on realizations and prices, because one, since exports will not be as much as in the quarter gone by, the difference in realizations also, if I'm not wrong, I mean, HRC prices were hiked in July. Can there be a further hike in August? Can you share some numbers there?
Yeah. No, globally, I think JES prices have improved from $397, which we have seen in the month of March and April, they have gone up to $480. So there is a very big increase in the Chinese steel prices. But it is not the same case when you compare with USA or Europe. Their prices are lower than China. This is the first time we are seeing where US steel prices are lower than China. So in line with fall in demand in other places other than China, there is a huge amount of supply adjustment which has happened. Almost 62 million tons of production is down in the rest of the world other than China in the first 6 months. So supply adjustments are happening in other places. China, even though producing more, they're exporting less, importing more. So their demand is quite strong. That is, steel prices remain at these levels or it will go up. When compared to our landed cost of imports, which are domestic prices at $480 FOB plus $20-25 freight, I think the landed cost of imports are higher, at least by 5 to 6%. So that is how we are seeing a scope for increasing domestic prices further in line with the landed cost of imports.
Okay. What about the debt EBITDA pictures? Because if I'm not wrong, and please correct me if I'm wrong, but I think the net debt to EBITDA shot up quite considerably in the quarter gone by. I think 5.74%, 5.74 times. Plans to reduce it? How do you do it? By when? Any targets?
No, we have given guidance of 3.75. So whatever debt to EBITDA numbers for 30th June is above our tolerance limit. But we are trying our best to bring down these ratios, relative ratios, as early as possible. If I compare 30th June versus 31st March, actual debt has gone up by 1,000 crores of rupees, whereas the relative EBITDA has gone down from 4.5 to 5.7. So the EBITDA for the quarter one has come down drastically. So 4 quarters trailing EBITDA if you take, I think the numbers will be worse. But going forward, we expect by end of financial year 2021, these ratios will improve because we are making a lot of efforts to improve our operations, to improve the volumes, to reduce the cost, to improve the product mix, and also complete the projects. One very, very important point here is out of 54,000 crores of debt as on 30th June 2020, 16,000 crore debt is for our capex program, which is not actually contributing anything to the capex. So if I take out 16,000 and take the core debt of the company for 18 million ton, I think our ratios are quite comfortable. It is only a matter of time where my expansion gets completed by end of this financial year. Incremental EBITDA from there and normal operations from existing operations. Both together, I think our ratios will substantially improve from here on.
Okay, touch wood. I hope that happens even sooner than what you anticipate, Mr. Rao. Just one final word, and if you can give us some thoughts on Bhushan Power and Steel, what happens? Let's assume everything goes well at the courts as well. What's next?
So Bhushan Power and Steel is in the last lap right now in the Supreme Court. It reached the Supreme Court, therefore it is the final authority to adjudicate on this matter. There are 2 or 3 litigations which are crucial to be decided. So we're also eagerly waiting because of the COVID-19 regular hearings did not take place. So we expect now the hearings will happen quickly and the adjudication will happen. We are ready to implement the plan as early as possible soon after the judgment comes from Supreme Court. So we are keeping a watch on when the dates will come from Supreme Court. As regards to other company, Asian Color, it is posted for hearing on 27th, that is Monday. Hopefully some results will come and we are ready to implement even Asian Color.
Too soon to talk about what would happen if indeed all goes well? I mean, would you rope in a strategic partner? What happens to cash which resides on the books of BP, Bhushan Power? Too soon to talk, or can you talk about it a bit? I mean, some thoughts.
It is definitely very soon to talk. Why I'm saying is we will complete the acquisition from JSW Steel, and at the same time we have been guiding right from beginning that we don't consolidate the debt of BPSL. The consolidation will happen on equity-based consolidation. So that is what we can talk right now. So once the transaction is complete, we'll be able to give more light on that.
Okay. Thank God. Well, I wish you all the best for the hearing on Monday as well as for the future ones, Mr. Rao, and all the best for the quarter. Hopefully, a 3-month quarter turns out to be much better than a 2-month quarter that has gone past.
Thank you. Thank you very much. All the best.